Hi there, welcome to the Pruscott podcast. My name is Megan Prusco, and I'm a residential and multifamily realtor here in Edmonton, Alberta. Today, we're talking to Jason Witherspoon, who has the sickest mustache that I've seen in person. So, if you're only listening to the audio, you're going to want to see the video in a little bit here. Jason is a life insurance agent. Trust me, you're not going to want to miss this episode. We go through some really cool stuff. We talk about your TFSA, RRSP, RESP for kids, and your FHSA so that you can learn which tool you want to be using, which one makes sense for you, how do they work, what's a contribution limit, all of that stuff we review. And yes, we do talk about life insurance, but it's to cover how you can use it as a corporate TFSA and borrow money against it and use it as an investment tool. It's so fascinating. Oh, I just love it. If you like this content, then please actually like it and subscribe. I hope you enjoy the conversation just as much as I did. Welcome, Jason, to the Pruscott podcast. I'm so glad to have you here today.
I'm happy to be here today too. Thanks for inviting me, Megan.
Yeah, it's a funny story how we met. I think you actually reached out to me on Facebook, right?
Yep,
Yeah,
yep.
and
And
then
then
we
we
met up.
met for coffee.
Yeah, and that was such a great conversation. There's like a couch in that coffee place. So I literally was sitting cross-legged with my shoes off on the couch. You were sitting next to me, and we were just talking for probably an hour and a half, and we hit it off really well.
Yep. Yeah, it was great conversation and I felt that we clicked right away. And obviously you had some interest in investing, not just in real estate, but in the stock market as well. And that's my specialty, I would say, more than the real estate stuff. But definitely there's overlap and just some great conversation was had. I really enjoyed our time together then.
Yeah, investing is really cool because it ties in like a lot of different careers or sector, like legal, accounting, real estate, stocks, right? Like it's just such an amazing topic. I do want to start with what is your career background and how did you end up in life insurance?
That is a great question. And I think I was probably in a career that was as far away from finance and life insurance that you could get. I was a welder. I went in, I started welding in 2005, started in finance in 2021. So, about 18, 17, 18 years, and really enjoyed the welding. There was good money, but I was away from home a lot. And I don't know if you've ever heard the term interviewing your future. Just watching these guys that have been in the industry, they're 60, 70 years old, can't afford to retire. We have a joke in the Boilermakers, that's the union I was with, that you're not a true Boilermaker unless you're on your second marriage, you're paying child support, and you've got a DUI. I didn't make it that far, but that was kind of where
Stereotype.
everybody was at. Yeah. And
Yeah, it's
so I
funny you
needed
say
to get
that
out of that.
because when I was in carpentry, I remember talking to a carpenter that's been in it for many decades. I was like, what is it like being in the industry for that long? He's honestly, Megan, if you want to be a lifelong carpenter, you're gonna have ghosts living in your bones. I was like, whoa, that's deep.
Yeah.
Just because your body just gets broken.
Yeah, exactly. And I would rather that that body got broken on my terms, not somebody else for too little money.
Mm.
The opportunity presented itself. It was actually another welder that I was working with. He's my senior broker. We've been in business together for 3.5 years. He was in probably, I think, about a year longer than I have. And so he's doing a lot of the business stuff that you and I had talked about with regards to life insurance. And so I love working with business owners. I don't know if we'll get into it too much in the podcast. Maybe we will. But my dad was a business owner when he passed away, 47 years old, way too young. But he was building his dream. And I remember him telling me, as a young man, 25 years old, I'm building your retirement. Now at 25, I was just getting started on my career path. I'm like, Dad, I'm not ready to retire. What do you mean? Fast forward to now, and it totally makes sense. And so I'm passing those same lessons on to my kids.
That's something really beautiful about the money industry in general, is if you're an outsider to this industry, and I had these thoughts too when I wasn't in the loop of, oh, these people are just greedy, they just want money, they're so selfish. But when you speak to people who are playing the money game, almost everybody's why is I want to provide for my family. And even people that want to retire early, it's so that they can spend more time with their family. So that's something really cool and a little bit off topic, but even if you read money books, like they're almost like self-help books, but they're focused on finances, a lot of it is very spiritual stuff. Change your mindset, focus on the good people around you. There's a lot of overlap between self-help, like getting your head straight, and becoming financially successful. That is really interesting because once again, if you're not playing the money game and you're just like looking up to people or looking at them, you're like, oh, they're just greedy. But the people that are in it, it's very cool to see like their reasons behind it.
Absolutely. I'm glad you said that. That reminds me of one of my most favorite quotes is when you don't have to worry about money, you're free to worry about the things that matter. And exactly, that comes to the why, the financial freedom, doing it for your family, time freedom, all of that. If you've got the money where you don't have to worry about where the next paycheck is coming from, how the next bill is getting paid, you're laughing.
What else do you do other than just signing people up for life insurance? Because your job is a lot bigger than that.
Yeah, it's with our agency, we're partnered with over 50 of the top financial companies right across the country. So as a broker, like you said, I can do so much more. We take a holistic approach. I'll sit down with my clients, find out what some of their dreams are. When do you want to retire? And just recently I heard the term work optional. And I love that term because for somebody, maybe they don't want to retire because they want to stay busy, and that's fine. But make it work optional so you don't have to work that job forever. And that's one of the things. Do you want to travel a lot in your retirement, or do you want to be a snowbird where do you just want to sit at home and have yourself a nice sit by the fireplace during the winters and maybe go to your lake lot in the summers? Whatever that looks like, we can help our clients put in the plan. Whether they've got debts, we can help them get out of debt. Like you said, the proper protection, investments. A lot of people are stuck at the banks. They don't know any better because that's what their parents did. That's what their grandparents did. Oh, this bank does good for me. Let me sit down and show you how your bank's not doing that great for you. Because if you're just stuck going to the bank, you've got a very small set of options. Whereas if I've got access to five, six, seven different companies for investments, six, seven, or eight different insurance companies, I can find the best of everything for my clients because not everybody fits into that box.
Yeah.
So those things, mortgages, like just so much I can do it. It's almost like, tell me what you're looking for and I'll tell you where I can help you. And if it's something I can't do, I'm expanding my network so that I can point you to somebody that I trust that I know is going to take care of you.
I mean, even myself, I know back when I was like 18, 19, I knew I should open a TFSA, so I did with my bank CIBC, and I put money in there, but I didn't really know that a TFSA is more of like a holding account than like an actual investment, and I was getting 0.05% interest. I was like, this seems so silly. What am I doing wrong here? That is almost an insult to be called a savings account or an investment
Yeah,
account at least. So I think
that's
having that fundamental knowledge, which nobody's born knowing this, but speaking to a professional like yourself or your lender or any financial advisor is really just going to get you so much further ahead because now instead of me making 0.05%, I'm making on average 7%. Look at that. That's insane.
exactly. Yeah, the last couple of years have been great. This year, yeah, the beginning of the year came down. We are coming back up a little bit from that. We're living in interesting times. And back to what you said about when you first put that TFSA in place, that wasn't, you said, what am I doing wrong? It's not what you did wrong. And I think a lot of people have a little bit of they're blaming themselves because they're adults. They should know a little bit better. But the institutions are not doing a good enough job to educate their clients. And that's why our business, World Financial Group, we were created to help the middle income earner, somebody that doesn't necessarily have $100,000 or more in assets to be able to access those higher earning options. You go to any bank, if you don't have 100 grand, they really don't want to spend time with you like you. Okay, we're just going to put it in the TFSA. Okay, thanks. See you later. They've got bigger fish to fry. Whereas in our industry, I want to sit down with people like that. I want to set you up for knowing down the road. that you've got the best options available to you, and that we're going to get you to be able to retire on time and sooner, in many cases, with tens or hundreds of thousands of dollars more in your retirement.
What do you do to stand out? What is it? What would I get working with you versus working with the typical agent?
That's a good question. If the beard and mustache wasn't enough,
The mustache is pretty sick.
I got some comments on some other training about that today, so that was really nice. I just like to make it fun. I'm 52 years old. I've been through the taking myself way too seriously phase. I just want to help people be comfortable with asking these questions and not feel guilty or feel stupid for not having it figured out. Took me quite a while to get stuff figured out. With all the information that we're bombarded with, it's tough to sift through it and understand what's good information, what's garbage. And I want to be able to be that beacon for my clients, whether they decide to become a client or not. I just want to be able to provide value and say, even if you decide that we wouldn't be a good fit together, I want you to know that I still have your best interests in mind. Whether it's letting you know these are some of the investment options, maybe you need to go with a term insurance instead of one of the more expensive permanent insurance options, how we can help you get out of debt sooner, just all those little things that should just be common sense. And there's the education's out there, but I think just a lot of people don't know what kind of questions they should be asking. Did
To
that did
touch
that
on
answer the
that,
question?
yeah, in a different way, said something that you mentioned to me when we first met. You had this kind of slogan, I would guess I would say. Said I focus on mission over commission. And that just oof, that hit me. That's a really good one. And I think when you're a service professional in any industry, if you want to actually enjoy your job and you want to actually be successful, not just in the short run, but in the long run, you really do have to have that kind of value.
Absolutely, absolutely. A lot of people just say, if that client was my mother or my cousin or my insert family member or person that you love, how would I treat them?
Yep.
How,
And I
and
say that
actually
too
just,
with my clients. They'll be like, "What do you think about this?" I'm like, "Professionally, it's all right, but if you were my best friend, then I would point out these to you."
yeah,
Yep.
yeah. I just heard on something on Instagram, just as I was scrolling, this comedian was saying that I like to look at people like me. Like his example was sitting on the plane, somebody's berating the flight attendant, and he's looking at it like treating that flight attendant as me. What would I say to that flight attendant if I knew I was talking to myself in that situation? And that just hit me. It didn't hit me hard, but just to understand that we are all just other versions of ourselves, kind of thing. Back to the kind of spiritual
Yep.
potential that we're all connected in some way.
I think
And
every human being on this planet, I would argue that all of them are doing the best they can with what they have. And what that looks like in your life might look completely different than someone else's life. Like, for in that example, that person berating the flight attendant, maybe if you lived their life and you had their brain, that is how you would act as well. Even they are doing the best they have or the best they can with what they have. Not saying that you agree with it, but ultimately, that's what everybody's in the same boat.
yeah, exactly. And when you get to that point, I think a lot of us just need to be a little bit more cognizant, a little bit more intentional, not just resting on our habits and thinking about how we're actually talking to somebody, looking at somebody, seeing them as a person, not just whatever else they may, because we never know what somebody's going through, what they've gone through, no matter what they look like, how they're dressed, anything. I think a lot of us are just so quick to judge.
Yeah. Speaking about that, is there a client that you don't think you're ever going to forget about? So whether you helped them and it was a huge success, or maybe it was someone that you wish they had just trusted you to help them.
Yeah, he's actually an agent of mine, but he reached out because he's a Boilermaker as well, reached out to me because his family had suffered a loss. His brother-in-law had passed away, I want to say 6 months to a year prior to him. He saw my posting on one of the Boilermaker group pages. He reached out to me. He says, I want to protect my family. I said, yeah, let's get together. So we got everything in place for him. He loved the business so much. He says, I want to do what you're doing so that what happened to my family isn't going to happen to other families. And then by extension, so he's been in my on my team for about 2 years now. In January, he put some insurance in place on one of his friends. And in, I believe it was late March or early April, that gentleman passed away. So he was only insured for 2 months. And now there was those funds that are available to his adult child, but his adult child has disabilities. So life's going to be more difficult. A little bit easier with an extra few $100,000 from life insurance policy. And I think about all those people that I'm able to help just even a little bit, whether it's putting insurance in place, helping somebody get out of a crushing debt through some kind of a consumer proposal or something, just helping their lives go a little bit better.
Yeah, I can just tell, even I knew this already, but just the way that you're talking and the stories that you're highlighting, and yeah, you actually care. Yes, you're doing this so that you can make money, but this is not just a pay stub to you. That's not what this job is to you. There is reasons behind it.
Yeah, there's so many trash advisors out there. There's not enough advisors, so they keep lowering the bar to get in. And so there's a lot of people out there that are just in it for themselves, going back to the mission before commission. Anytime, I meet with somebody, my first question is, have you got insurance? If so, let me do a review of your policy to make sure it's a good policy for you. And I would say probably at least 50% of the time, it's not. You can tell when that policy was put in place more for the advisor's bank
Mhm.
account than it was for the client. Sometimes I can fix it, sometimes I can't, and I do my best to get them something that works better for them.
Yeah. Yep. Tricky people, they're everywhere in every single industry. I do
Yeah,
want to dive into the macro topic of today, which is discussing our registered accounts. So we're going to go through TFSA, RRSP, FHSA, and then in the end, we're going to talk about life insurance, permanent life insurance, and how you can use that as a corporate TFSA, which is mind blowing. I was up till 2 in the morning the other night watching videos about it. Like I
well,
kind
that's
of knew
awesome.
before, but then now I really know, and it's super cool. But we'll start with the FHSA because I think that's a really safe one to start with. What is an FHSA, Jason?
So it's a first home savings account. I don't remember exactly when they started it. I want to say at the end of 2023.
I think you're right. It's
Um,
very new.
it's very new, yeah. And people describe it as RSP and a TFSA had a baby. So basically, it's just tax-free money that, let me back it up. You're not paying any taxes to earn that money as long as it goes into that account and then as a down payment on your first home.
So it's
So
that's how it's like an RSP where let's say I put $10,000 into my FHSA. Now when tax time comes around for that year that I've now closed, like you could reduce your income by 10K because you moved that 10K over into the registered account. So you're deferring your taxes on that 10K.
exactly. Yeah. And then on the back end, it's like a TFSA. As you're aware, with the RRSPs, you pay it on the back end. With the TFSA and the FHSA, no taxes are paid on the back end. Whether it stays the same gains, hopefully that's the plan, or loses. No tax on the back end, but also no capital losses that can be claimed. So that's a trade-off there.
Yeah, it's
Mm,
beautiful. I think with an FHSA, the only well, that kind of sucks is you have to strictly use it for a purchase of a home. Like you
yes.
can't
Yeah.
just pull 5 grand out because your car broke down. No, if you're pulling that money out, it has to be for a house.
Yeah. Or the government's going to take
Yep.
those taxes back. And just to add on to that as well, it's $8,000 per year. I'm pretty sure you can carry it forward up to a maximum of $40,000. And it's got to be used within 15 years of when you open that account. So definitely a lot of time to some of those life events happen that delay you from buying that home when you wanted to. You shouldn't be penalized too soon.
Yeah, so if you're looking to buy a home anytime soon, like even within the next 5, 10 years, just open the account. You don't have to put money into the account, just register the account because then it'll get triggered. Okay, 2024, you opened the account. So for 2024, you can contribute 8 grand. And then in 2025, you get another 8 grand, so a total of 16. So if you open it right now, even though you're not ready to buy a house quite yet, you're going to have much larger contribution room.
Yeah, and that's what I tell like I've got a couple clients that are looking to buy a home this year. And I said to them, let's open it up because it just basically the money just has to touch down in that account and then it can come out like 48 hours and then you get that tax savings. So
Ooh.
boom, put 8 grand in that goes out back into the house. You're gonna save the taxes that you
I've
made
never
to.
thought about using it in a short-term way, but there is an obvious benefit to using it short-term. I, in my head, always think of it as long-term, but yeah, you just got how much of a tax credit for the down payment of your home of just having that transferred through the account in 48 hours?
Yep,
That's really cool.
yep.
You taught me that. Very cool.
Yeah, 2 or 3 grand it could be, right? That can go into your RSP or the TFSA or something come tax time.
What about TFSAs? How do those work?
Yeah, so a TFSA should be called a tax-free investment account, as
Mm.
it's not just for savings, earning you fractions of a percent sitting there doing nothing. It's money that's already been taxed goes into a TFSA, but you never have to worry about paying taxes on it again. So ideally, you invest it in something wisely and it's going to continue to grow so that when you withdraw it, you've got so much more tax savings because you've made that money. I like to use the example of if you put $100,000 in a TFSA over your lifetime and through some wise investments, you grew it to $1 million, you've just saved the taxes on $900,000
Yeah.
and some of the
TFSAs
limit.
are
Sorry,
very
go ahead.
versatile too, because you can invest through your TFSA. Your TFSA, once again, is just a holding account, and then you have investments in that holding account. So you can invest in GICs if you really do not trust the stock market at all. I think GICs are a little silly, but to each their own. You can invest in the stock market. Most people will go with ETFs if they're brand new. And then you can also invest in stocks, or through TFSA, you can also get an actual high interest savings account. I think in my TFSA, I have one for stocks and one that's a high interest savings account that I put like my tax money in so it can marinate for the year. And that high interest
Fantastic.
savings account is, I think, 3.75% interest with my account. So
Okay.
if you're
That's good to
thinking,
hear.
like, I have a TFSA, but I really don't trust the stock market because a lot of people feel that way, you can get a high interest savings account in your TFSA.
Yeah, definitely. And I'll add on to that. You can also, I know there's some real estate investments that you can invest in within your RRSP and TFSA. I'm not entirely sure how those work. Those are a little bit out of my wheelhouse,
Are you talking about
but
REITs?
no, not necessarily REITs, but there's a few real estate investors that I know that they can do their joint ventures with the funds that you've got within your FHSA and
Mm.
TFSA, to
I know
my
with
understanding.
your registered accounts, I just had another interview with a different Jason, Jason Watson, not Witherspoon, and he does private lending. And he was saying with your TFSA or RSP, you can transfer your TFSA funds over to a different TFSA holding account, and then you can actually lend that money out at whatever interest that you can get for it. People can use it on real estate. And then, yeah, you're just lending your money out, and whatever interest you get on your money is tax free because it's through your TFSA, which is crazy cool.
Yeah, yeah, definitely. Like there's so many vehicles that we can use for investments that we're just scratching the surface here. Like there's so many, like you can go a few different levels deep and different strategies that have 2, 3 steps, like things like the Smith maneuver, which I know we don't have time to get into that today, but there's so many different options out there and opportunities where the average Canadian is just looking at TFSAs, RRSPs, and hoping that their money's going to be there when they retire.
which is better than most people. I don't think most people have those accounts or can contribute consistently to them.
Yeah,
So at least they have something. But yeah, you can be very creative with it. There's so many options out there.
yeah.
The last obvious registered account that we have here in Canada is an RRSP. How does an RRSP work?
So the RRSP is that's the one that most people are putting their money into so they can get that tax savings at the end of the year. So whatever tax bracket you're in, you would get those funds back. For instance, the way in RRSP, like the max of it is the lesser of 18% of the previous year's income, or 32, I've got the numbers here, 32,490. And
I don't
that's
know
for
what that
2025.
means. Can you explain that to me? I
So
don't get it.
so let's say you earned $140,000.
Sure.
So you can put either 18% of that or $32,490 into your TFSA for that year, whichever
Mm.
is the lower amount. And you would get back the taxes that you paid to earn those funds
So the
at the
cap
end of the year.
isn't like a set number like an FHSA where it's 8 grand a year, period. Like the
No,
contribution cap is different for RSPs.
yeah. And then if you've got a pension, it gets offset by whatever goes into your pension, but you can carry that forward basically forever.
And then,
So,
so when you put the money in, then you get that credit back for how much money you put in. But
yes.
when it comes to time to typically retire, that's when most people will want to pull the money out. What happens then? So let's say, just for easy numbers, I put in $100,000 and it grew to that million, that
Mhm.
example you gave. What happens when I'm 85 years old and I'm pulling from that now?
Yeah, so the idea is that you pay it while you're earning and you're in a higher tax bracket, you save that money and then you withdraw at a lower tax bracket.
Mm.
So anything up to, I can't recall what the exact number is. It's somewhere in the 18,000 something, I think, is tax free. Anything above that, I think up to 52,000. I'm not sure what the tax bracket is. I really should be better at these numbers. But then you're going to pay taxes on that. So, say you're in that $32,000 tax bracket or 32% tax bracket, that's what you're paying taxes on the withdrawal. Definitely the idea is to not be having to have $150,000 a year in payments in retirement because you're going to be in one of the upper tax brackets. So that's why we hope our mortgage and all our debts are paid off by the time that comes.
I'm curious to
Um,
know your thoughts on this, but in my opinion, and no, I'm not a financial advisor, but in my opinion, I think the order that you should be filling up your accounts is your TFSA or FHSA, depends on if you're buying a home right away, but TFSA or FHSA. And then once those are maxed out, you should contribute to your RRSP. I think that's what you
yes,
should do. I just think
I
RSPs,
agree.
I don't want to call them a ripoff because they serve a purpose and you do get to push forward your taxes and kick the can down the road. But I think that should be the last one for you to fill up.
Yes, yeah, I definitely agree. And we talked a little bit in the beginning about business owners. They don't really have the op. They do have the option, but what they've got to do is take their money out of their corporation, pay the tax on those dollars, and then put it into an RRSP or a TFSA. Whereas ideally, they could keep those funds within the corporation, not pay employee taxes, and then there's just a much larger amount going into that savings for them.
I guess we
So,
can break into life insurance. So, what I learned about this, once again, I kind of knew, but now I know more, is if you're getting permanent life insurance, this does not apply for term life insurance. But if you have permanent life insurance, then you can, if you're a small business owner or a business owner, you can use your corporation to pay for your life insurance. And then let's say you're contributing $100 a month. That $100 a month gets held in almost equity or cash in that account. And then that cash, it just stays there. You're either going to get dividends from the insurance company or it's going to be invested in a stock market as well. So it'll grow that way. And then you can actually, if you need to, pull the money out, which isn't always the best way to go, but you can at any time, just the equity amount, not how much you're covered for. Or what makes more sense, oftentimes, if you're an investor, is to get a loan against the equity in there. So if I have $10,000 saved in there and I have a $100,000 policy, I can get a loan for $10,000 because the bank is saying, obviously, I'm going to get paid out. This is an insurance policy, so I don't really have risk as the bank. I know I'm going to get my money either way. And with that, it works as a TFSA. So if your TFSA is filled up and you really like your TFSA, you can just open life insurance. And I think you told me life insurance was a TFSA before TFSA was a thing.
Pretty much. Yeah. The one percenters have been using that strategy for generations to put their wealth away. Tax shelter, it was the original tax shelter because it grows just like a TFSA or an RRSP tax free. And if you strategize right, you can completely avoid ever paying taxes on those funds through borrowing against that policy. If right now you could probably borrow against that policy somewhere in the neighborhood of 6%, which is still better than even paying taxes on those
Mm.
funds. Yeah, definitely that is the way to go. And I'm not completely 100% versed in that. Like I said earlier, I'm still learning some of these intricacies. And it just, every time, like the very first time I heard about this, it just blew my mind. Why isn't everybody doing this? A lot of people don't know about it. It hasn't been available really because
And I think if
it
you're
can
an
be kind of expensive.
entrepreneur and like myself right now, I'm covered underneath my husband's work policy, but if I didn't have him, I don't have life insurance of my own. So if I pass away, my beneficiaries are only going to get what's in my bank accounts. Whereas if I got life insurance, I'll pay that, let's say $100 a month into my life insurance. It's working as a TFSA, kind of. And then if I pass away, let's say I had a $500,000 policy, then my beneficiaries are going to get $500,000 if something happens to me. I'm covered because of my husband, but if I didn't have him, you're driving without a seatbelt and no airbags and no brakes. Like
Yeah,
you gave that example at the beginning where your friend who joined got their friend in a policy and good thing they did because you never know.
yeah. We're not guaranteed tomorrow. You never know what's going to happen. When I drive down the street, my seatbelt is on not because of me, it's because everybody
Mm,
else out there. So, yeah, we never really know. And health-wise, you never know when something could just pop up and stop the ticker from beating.
yeah. So you can help clients with all of these kind of accounts, but what does it look like? If someone reached out, Jason, I saw this episode. I saw that you could help me plan my finances, whichever situation I'm in right now. What does it look like working with you?
Yeah, so basically just similar to this, just a Zoom call because I Zoom's so much easier. Nobody has to travel anywhere. I still prefer meeting in person when it's possible. Sometimes, of course, depending where somebody lives in the country or the province, not able to. But we'll sit down, we'll just look at what your goals and dreams are, because that's number one. That's your why. Why do you want to get out of debt? Why do you want to save money? Why do you want to retire young? And figure out how we can get you there. A lot of people, just like I said before, just aren't haven't had that education on how to use their money. One of the biggest things is paying yourself first. A lot of us, you get it payday, it's I'm going to the restaurant or I'm going to the bar. That 50 or $100, if you put that into your personal plan, what's that going to look like 20, 30, 40 years
And
in the
it
future for
sounds
you?
so cheesy to be like, if you just save $50 a month for the next 20 years, like everybody's heard something like that. But I have a financial calculator on my phone and I love playing with those numbers. And you're talking about paying yourself first, and that's something that didn't click with me at first. What that actually means for me, paying myself first means I'm on commission. So every 2 weeks, I just have an auto deposit to go to certain investment accounts. And you can choose the amount, you can choose the frequency of those payments, but have it forced savings. So like now I'm just used to having money every month that comes in my account and right away it goes out to a different investment account. So that's me paying me. And then when I look at my remaining balance in my checking or savings account, I'm like, oh, I only have this much to spend now because the rest of it disappeared, but it's still there. It's just in a different account now.
Yeah. Yeah, I think a lot of people think that they're giving their money away to somebody else. And if they can just flick that switch and going, I am putting that money away for future me when my body may not be capable of earning the income that I'm able to earn right now, or whatever, whether it's an emergency fund, investment, retirement fund, personal protection, all of those things. We don't need to spend 100% of our income right now. I think
Hmm.
about the majority of Canadians, because since I've been in this business, I'm always thinking about all the people that are paycheck to paycheck. And one financial or one sickness or one injury away from financial ruin potentially. Who
And
knows what
it's
that could
it's
look
not
like?
just like illness that could happen to you, or you're not just investing for retirement. Like you can, absolutely, but even for myself, I got laid off on my construction job, and if I wanted to become a realtor, which I did, that was several $1,000s for my licensing, supporting myself while I wasn't working. And if I didn't have that cushion, I don't know if I could have been successful as fast as I was. I definitely know that I wouldn't have made as smart of choices as I did. And that's if you don't have that financial security, you fall prey to making bad decisions because in your head, you have no other choice.
Yeah. Yeah. In survival mode, like there's two choices. Is out the window. It's can I get by doing this?
Yeah.
So
Or like people who are in a toxic relationship, either with their family or with a partner, or maybe you just really hate your roommate and he always eat your snacks and you're just done with this guy and you want to move
yeah,
out. If you don't have the money, you're stuck there. So I think
yeah,
that's what people miss when we say money is freedom. I think people think, oh, money is greed. No, money is like the choice to act in your best interest.
yeah,
And not everybody has the ability to do that or have the funds that can do that.
yeah, exactly. And that's again, that's some of our training, some of our schooling. I don't want to get too much into that right now. Largely, what we get paid for value, and a lot of people just stop learning how to provide more value so that they can earn a better income and provide better for them and their families. They just get comfortable. And I've been there myself.
That's actually
Comfortable.
something I was thinking about last night, actually. I was thinking when you're working in a sales job, which we both are, you're paid
Mhm.
for value. That's not a secret, but you do have to look at yourself in the mirror. If you're having a low income month or low income year, you do have to look at yourself and say, I have not been valuable to my clients recently. And that's on you. And you may have a reason for it. You may be okay with that. But when you're in a commission job like ours are, you really have to face the music of if your paychecks aren't there, that's because you are not being a valuable service. And that can
Totally
be
agree.
hard, but it's true.
Yeah, yeah. There's at the end of the day, you look through everything that happened in your life, and there's one common denominator, and that's you. So if I didn't earn enough in my past career 1 year, what jobs did I not take because I didn't want to go to that job, or just so many different things. Like you said, it falls on us.
What is a client that you had that you were able to help and you're just like, oh, I'm so happy for you?
A lot of them.
Yeah,
One of
that's a
them,
good response.
one of them, I'm just really stands out. It wasn't because of the money, because mission before commission, but they had some furniture that they had bought, one of those do not pay for 2 years or something, and then at the end of the
Mm.
2 years, whatever rolls onto a credit card. That credit card was like 42%, and they were a one income family. Mom was home with the kids, and just they were crushing under that crushing debt. They couldn't afford to get life insurance for dad. So if something happens to him, then what's happening to the rest of the family? GoFundMe is not going to provide enough. You'll always hear me railing against GoFundMe. It's great to have an option like that, but I think too many people think that it's
Rely.
a good plan B. No, it's like a band-aid on a severed artery. It's good for a little bit, very little. So we were able to help them get out of that 42% credit card, free up some cash flow for them so they could put some money away so they could get that policy so that if anything happened to dad while he's at work, family's still protected.
Yeah.
So those are the families that I really think of.
That's fantastic. And obviously, we talked some about permanent life insurance. But from what I understand, there's three different kinds. There's term, and then there's permanent whole life, and then permanent universal. Can you explain the difference between those three?
Yeah, so term is basically just like renting. So it's just there temporarily, maybe to cover the term of a mortgage or until the kids are old enough that they're able to earn their own income, go to school, that kind of stuff. And usually those ones expire around age 75 or 85, depending on the carrier. Universal life is the next in line. That's the one where half the money goes to your insurance cost and then the other half gets invested where you mentioned in stock markets. We can also invest in GICs. I'm not a fan of GICs, but there is a place for them. They don't really keep pace with inflation, especially the last couple of years where we saw nearly double digits. But we can invest in the market there, and then we get into the whole life. That's a Cadillac of the life insurance policies. Those ones they're more expensive, but you're compressing the time that it's paid off. You can go as low as 8 years, have the whole policy paid off in 8 years, then it just stays for the rest of your life. And when you set it up properly, you can put extra funds into it. And that's where the tax shelter capability comes from. And so the returns on the whole life are dividends, or they're also called return of premium. So those are usually in the neighborhood of 6 to 6.5% currently. And those returns are guaranteed on whatever funds are in that, whatever the accumulation fund is. And so you can put extra funds into it. So down the road, you can have hundreds of thousands, even millions of dollars in those policies to be able to borrow against. We discussed that a little bit for high income earners and business owners to be able to access those funds. I usually recommend don't go and buy a Lambo with that, but
Hmm.
use it for some kind of an income producing asset. Maybe for real estate investors, it's great to put on a new investment, and then whatever that investment is positive cash flowing, that can then pay off that loan, or using it for your business, maybe paying employees and then goes back into that policy. So, you're saving the taxes that you would have paid on the growth of those funds.
So I think whole life insurance is like a closed system. So whole life, you're not invested in the stock market. You're strictly
Yeah.
getting dividends from the insurance company based on the equity you
Yes.
have in the policy. But universal life insurance is when you can invest in the active market, right?
Yes. Yeah.
That's very cool.
Yeah. And so you've got the options of, like I said, GICs, conservative kind of investments, if you're a lower risk type of investor, right up to full equity. You're going to see the funds in your policy jumping around quite a bit, like the stock market. It's good over the long run. However, I would caution people, keep an eye on things when you're about 5 years before you want to access some of those funds,
Mm.
or just think about where you are in those funds. And then in regards to borrowing against the funds, with a whole life, you can access up to 90% of those funds because the returns are guaranteed and it's not contingent on what the stock market's going to do. Whereas the universal life, that usually is in the neighborhood of between 60 to 90%. And that is based on what you're invested in.
That's In my head, while you were explaining that, I was just thinking of it as like a house, and like the money that you put in on your premiums is your equity in the house, and you could get a HELOC basically on this life insurance, which is a line of credit or a loan
Yep.
against the equity that you have in your asset, whether it's a house or whether it's life insurance. And then you were mentioning you could pull that money out and buy another asset with it. Same thing you can do with houses. And it's really neat. And then when you're talking about whole life, you can get up to 90% and then universal 60 to 90. That's your LTV. That's your loan to value that we talk about
Yeah.
all the time.
Yeah.
And really, it's the same language, guys. Like sometimes it's used different words, but it's the same story, which is so
That's a great
cool.
comparison. Yeah. That's a fantastic comparison, Megan.
Yeah, I think, yeah, life insurance is definitely something I'm interested in. I think it's fascinating to use. I don't think it's for everybody. It might be overkill for some people for like permanent life insurance. I know some people that just have term life insurance, which is great because
Mhm.
I think what you were getting at earlier is sometimes the life insurance agents, they will push the permanent policies because I believe you guys get a bigger paycheck if you get a permanent
Yeah,
one signed than term. So I think
yeah,
that's where the do I trust this guy comes from. But something I was watching is that most people don't actually need coverage up until they're 100 years old or whatever. Most people need coverage up until they retire because by then they're probably going to have savings of their own. Their mortgage is probably paid off. Their kids are probably grown up. So do they
yeah,
really need a payout if they're over 65? Maybe, but it's not as necessary versus
yeah.
when you're young, you don't have very much. So if you pass away, you're leaving a really big hole behind.
Yeah, exactly. And one of the things that, especially since you're a real estate investor and a broker, or pardon me, agent, is if you've got a lot of properties, then if you pass away, there's going to be capital gains that's going to
Mm,
be passed on to your family. So how are those capital gains going to get paid? That life insurance policy solves for that problem.
yeah.
Or if somebody doesn't have, a lot of property, a lot of something to leave to their family, a life insurance policy can solve for that. Not necessarily covering debt, but just a lot of people, my dad left me his house. If you can't leave something like that, you can leave the legacy in life insurance policy. And it can also go to charities, things like that as well. So
Yeah, I think what you explained of like using the life insurance policy to pay out the taxes on assets, that's like a 1% of the population need to use that strategy.
yeah,
Like that's not the everyday Joe, but that is exactly what they do because I watch a bunch of videos about it, so I'm an expert now. But yeah, that's what they do is to soften the blow of the capital gains cast. Geez, my words, capital gains tax. They'll just use the life insurance policy to pay for that, so then the family gets to keep that asset.
we were talking about I remember you had asked about how a life insurance policy could compare to an RESP. I don't know if that
Mhm.
was what you were
Oh yeah,
thinking
we
about,
didn't talk
but
about
we had.
RESPs. You wanna? I do not know very much about RESPs at all.
Yeah, so an RESP is a registered education savings account. Parents can put into that for their kids. I believe it's up to their kids are 16 or 17. And government will match contributions up to $7,200. I think it's a maximum of about 500 a year. I don't do a lot of RESPs, that's why I'm not up to speed on the numbers. Kids can use those for education, post-secondary, those kind of things. There is a limitation on which post-secondary facilities, which
I was just
schools can
thinking
be
of that.
used,
I think
but
Polyev,
I'm
when he
not.
was campaigning, he was trying to push that RESPs could be used for trade schools because right now it's not eligible for trade
Okay.
schools.
Yeah, that would be a great idea.
Fantastic
Yeah,
idea.
yeah, yeah. And then one of the cons of the RESP is if the kids don't end up going to school, you've got to pay back the grants to the government plus 20%. And then whatever funds are left over goes into the parents' or RSPs.
Yeah.
So when I'm sitting with clients and they want to save for their kids, obviously that's a great option. If you know the kids are going to go to school, perfect, let's do that. I also recommend let's take a look at a child UL. We call them peanut plans because
Yeah.
kids are young and healthy. The premiums aren't going to be that much. You can put extra funds into that, almost like you're putting funds into an RESP. It guarantees your kids' coverage. So no matter what happens, mental health is very prevalent these days, and some cases that's usually diagnosed somewhere in the teenage years, and that can keep people from getting life insurance coverage. If you cover them young enough, they've got their coverage guaranteed. You can put the funds in there. Maybe they're 18 or 20. They decide not to go to school. You want to buy a house. You've got funds in there you could use to buy a house. You could use to buy a vehicle. Maybe open a business. All
But I think
those
with
different options.
ULs, that account stays in the parent's name or the guardian's name. So technically, I think it stays in the like it's registered for the little kid, but the account holder is the parent typically. So the parent gets
Parent
to
or guardian.
decide. Yeah.
Yeah. Yeah. And then once the child turns 18, then the parent has the option to turn it over to them. And then at that point, the child can do whatever they want.
So I
I don't
remember hearing
recommend.
let's
cashing
say
it
you
out.
have a child that you don't really want to trust them with the money yet for whichever reason, that you, the parent, could hold on to that money until they're like 25 or 30 and then maybe help them out down the line because technically that money still belongs to you, even though it's there to benefit your child. You have complete control of it.
Yeah, because the parent is the owner of the policy up until they sign it over to the child.
Yeah.
Yeah,
I remembered what I was gonna talk about before it came to me. Um,
perfect.
I'd have to find the graph again, but I was listening to this other financial advisor in Canada, and he showed a graph of the stock market during crashes versus, or just stock market historically versus permanent life in policies. So the whole life, I believe, would be the dividends ones. He was showing during the massive crash in 2007, 2008, where the market just plummeted. Life insurance still went up the usual 7%.
Yep. Yeah, because
God damn.
closed system, like you said. Yeah,
And he was saying that life insurance, like for dividends, they have never once not paid the dividends. Like they are guaranteed, which is,
yeah,
I don't know, that's my new kick right now is life insurance. I just think it's so cool to learn about.
yeah, yeah. It's because like you said, it's a closed system and it's based on mortality. So however many people that they've got insured, if it exceeds the amount, then maybe that dividend would be a little lower.
Mm.
And then if it doesn't exceed, it goes right back because it's a mutually owned. The best ones for those whole life policies is a mutually owned, which means that whoever owns the policy has an ownership interest in that insurance company. One of the big names across Canada is Equitable Life. That's the ones that we use. Most advisors are using Equitable Life for those policies. I don't know if I can say the name on your podcast, but that's who we're
Yeah.
using.
Yeah, I think that's really neat and just what a fantastic tool. That's all of my questions for you, Jason.
Awesome. I passed the test.
Yeah, pretty easy, hey?
It is pretty easy, yeah.
Awesome. Thank you so much for joining me. If somebody is looking to reach out to you personally, how can they do so?
Um, Phone number 780-974-5401. Always looking up, looking forward to having a chat, providing value. I'm not going to try to sell you anything. I'm going to help you solve the problems that you're facing, whether it's financial. I'm 52 years old. I got a little bit of life under my belt, so I can help with some of that stuff as well.
Perfect. And yeah, I just want to thank you for joining me again. It's always so great speaking to you. Like always, I just have such a pleasure, and it's hard not to enjoy speaking to you when I get to stare at that beautiful mustache.
Thanks. I appreciate that, Megan. And I always enjoy speaking to you as well. I know we've got some very similar thoughts on investing and how we can help people. And so always look forward to it.
Awesome. Thank you again, and I hope you have a wonderful day.
I will. You too. Thanks, Megan.
Bye, Jason.
Okay, bye-bye.
Thank you again to Jason for joining me on this episode. You can tell the conversation just moved smoothly. We were both enjoying ourselves, and the content was really, really exciting, to me at least, and I hope for you as well. If you're looking to reach out to Jason directly, you can do so with the phone number in the description below. If you have questions about something we talked about and we didn't quite clarify, drop a comment down below. I'd love to cover that content for you. Thank you so much for sharing your time with me. I hope you have a fantastic day. Bye for now.